Everyone is celebrating lower inflation, but affordability is quietly getting tighter beneath the surface. That tension is where regime shifts begin. Our strategy does not focus on a headline that says inflation is cooling. We focus on transmission mechanisms. And when we examine housing affordability, income thresholds, credit dependence, and structural cost floors, the signal set looks less like stabilization and more like compression building underneath the system. The common misunderstanding is this: slower inflation does not reverse cumulative price increases, it only slows the speed of additional increases. Since 2019, shelter costs, insurance, healthcare, and financing costs have structurally repriced higher. That creates what we define as an affordability squeeze regime. Asset prices can stay elevated while real purchasing power quietly erodes. That is late-cycle behavior. The mechanism is straightforward. Wage growth lags cumulative cost repricing. Credit temporarily fills the gap. Then refinancing friction and debt servicing costs begin to tighten the system. Housing becomes the transmission channel because shelter is the largest household expense and the largest collateral base in the economy. When ownership affordability breaks, rental demand rises. When rental demand rises in supply-constrained markets, pricing power concentrates. That is not automatically a crash signal. It is a structural compression signal. If you find this kind of signal-driven analysis helpful, consider subscribing. Not because it helps the channel, but because it helps you build a consistent macro lens. Instead of reacting to headlines, you begin to see sequencing, confirmation, and invalidation in real time. That shift alone can materially improve how you interpret markets. As we project forward into June 2026, we assign roughly 60% probability that affordability pressure continues without systemic break. We assign about 30% probability that labor softening combined with credit stress accelerates this into a broader breakdown window before December 2026. And we assign roughly 10% probability that productivity expansion offsets the squeeze and extends this cycle longer than expected. What determines which path unfolds is not narrative conviction. It is confirmation. We are watching labor hiring rates, consumer credit delinquencies, bank lending standards, and long-duration yield behavior. If long yields stall and roll lower while credit spreads remain contained, that supports controlled compression. If yields remain elevated while labor weakens and delinquencies rise, Phase 3 pressure increases meaningfully. Quick reminder: this is educational analysis built on probability modeling within our strategy framework. It is not investment advice. What does not change is sequencing discipline. Lower inflation alone does not restore affordability. Structural cost floors matter more than short-term prints. Until credit and labor confirm escalation, this remains late-cycle compression rather than forced liquidity. The objective is not to predict collapse or boom. It is to identify when compression transitions into mechanical stress. And that is a signal we can measure.